Welcome, everybody, this afternoon to the March 2024 market update with Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide. Let's talk about our distinguished speaker, Mike Ott. He brings a wealth of experience to the table with a background as a former public school teacher and an impressive 19 plus year time in the mortgage industry. Mike has earned a stellar reputation. His unique educational approach and unwavering commitment to excellence have endeared him to both clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update really an indispensable guide for you guys. It's really unique and it's very complete. That's why we have it a little later in the month because Mike waits for certain reports to come out, which I think is a real testament to his quality. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status as a highly regarded and sought after trainer with Cindy Bishop Worldwide further underscores his expertise. Please join us in extending a warm welcome to our presenter today, Mike Ott. Take it away.
Awesome. Thank you very much, Cindy. Good afternoon, everybody. Welcome to the March update. Hard to believe we're in March already and approaching the middle of the month. All right, let's start where we usually start. Let's look at rate ranges on the products. We have seen some slight improvement since about the end of February, probably the 21st, 22nd of February. We've had some improvement, which is nice to see these rate ranges kind of come down a bit from where they were last month. Conventional conforming, we're looking anywhere in a range of 6 3/8 to 6 7/8. On the high balance of jumbo, obviously those are always going to be a little bit higher, and we're trending 6 3/4 to 7 1/4 there. On your Govy products, your VA loan rates 6 1/8 to 6 5/8, and then FHA and USDA about 6 1/4 to 6 3/4. So we've seen that shift. Maybe a good solid 3/8 from where we were when we did this in the month of February. A good place to track national average is mortgagenewsdaily.com. If you're returning, I've always kept that up there. I think that's a good free resource for you. You don't have to subscribe. You don't have to pay any type of membership. It's a good place for the general public to go. And it does a fairly accurate job of tracking an average on the different loan products. And for those of you that are joining us for the first time, definitely check that out. All right, mortgage-backed securities. Why do we see this improvement towards the end of February? Well, I've put a little channel there, if you will, around these candlesticks, and this is mortgage-backed securities. This is kind of what we in the lending world kind of keep an eye on. And for those of you that are seeing something like this for the first time, when we look at mortgage-backed securities and we're looking at the price, we have to understand that the price has an inverse relationship to the rates that can be offered to consumers. So when you see this upward channel that I've highlighted here over on the right-hand side, starting at the end of February, when the price of the mortgage-backed security coupon goes up, that means the rates offered to the consumers go down. So we've got that inverse relationship. Now, in the last 3 days, you see we've got some red, and we see kind of a little bit of a reverse course, but we are sitting nicely on that black line there at S1, which stands for support. And that is the 50-day moving average. So we've got kind of a dual layer of support there, if you will, with the 50-day and then below it, the 25-day moving average. And it's amazing that when, the market isn't volatile or being influenced by outside or worldly or global events, that this stuff pretty much holds true to the technicals. Obviously, what we're looking at today, we're going to talk about the CPI inflation report that came out this morning. That's the reason for the little bit of a dip that we're seeing here in the chart. So, we're probably going to see rates pricing wise, maybe 3/8 to 0.5% more Meaning if you took the same interest rate, let's just pick one, 6.25, right? If 6.25 cost 1 point yesterday, then today, right now, it probably costs what, at least 1.125, maybe 1.25. So you have a fluctuation in price. And it's not enough fluctuation in price where the rate from one day to the next is different. It's just the cost is what's fluctuating. So yeah, that's our, what we're looking at, what do I watch today? I watch, do we hold this support level 1? And right now going on in the background, and obviously I can't keep an eye on it, but we have a 10-year treasury note option that if that goes poorly, we could see some more deterioration and it could push us below that support line, but fingers crossed that we can hold that, and at least by the end of the day, stay above that 50-day moving average. Because when you see, if you follow that 50-day moving average black line, you'll see that when mortgage-backed securities go above or below that, they tend to stay for a while. Now, we haven't been above it for very long, so it's not a true indicator that, hey, everything's looking rosy. And the last 3 days are a good indicator of, some of that, the data that's coming out in the market. And we'll have wholesale inflation data later this week. We'll have retail sales, which the markets always pay attention to. And then we'll have consumer sentiment. Now, I always say it sounds bad when I say this, but if we want mortgage interest rates to cooperate and trend downwards, we actually need lousy numbers on that. We need lousy consumer sentiment. We need to have people feeling like they're down on the economy. And then we need to see retail sales coming in lower. Retail sales coming in high, it's a sign, it's an inflationary set of data. And then again, things when they come in high and they're inflationary, it just gives the Fed more fuel to keep rates higher for longer. And that's been their recent dialogue. All right, so since last meeting, we had January PCE. That is the Fed's favorite measure. They really look at that core rate. The headline year over year dropped 0.2 from 2.6 to 2.4, which is great. We love seeing that. The core also dropped from 2.9 to 2.8, which is great. Again, when you annualize that over the last 6 months, core inflation, it did go up, but we're still at 2.46. And the reason why that went up is we definitely had some hot numbers. And as soon as we had that PCE report come in the jobs data that we're going to talk about, employment data that are in the next couple of bullet points, the Fed members were out there, they were speaking publicly, and all of them seemed to be banded together of it's too soon to talk about cutting rates, and they're kind of holding steady to that mentality right now. Now, our next report for PCE will be at the end of this month on March 29th. Last week we had ADP employment showing 140,000 jobs created when 150 were expected. This was, again, good news for mortgage rates because we missed the expectation that ADP had for employment and job creation. But then the thorn in the side has been the BLS jobs report. Also came out last Friday. The market was expecting 200,000 jobs, and we got 275. And if you were here last month, we got a big blockbuster number that has been adjusted down twice. But the problem is when these numbers come in hot, the markets and the investors, they trade on the headline, right? They don't necessarily dig deeper into the report and say like, oh, well, yeah, even though we had over $300,000 or over $300,000 jobs created in January, they're not looking, they're not paying attention that those were revised down to like 167,000. So, the reality in this BLS jobs report is really becoming, problematic in the fact that these numbers that come out, we're almost expecting them to be hot every month. And then the following and subsequent months, we'll see revisions downward. And a lot of it is problems in the modeling. And one of the things that they look at, and the Fed's paying attention to, is shelter costs. And we know that real-time shelter costs are down quite a bit from their highs, and this is rent. And then the one that's problematic is called owner's equivalent rent. And it's a very poorly done survey in our position from the mortgage industry, because this is essentially calling homeowners and asking them what they think they can rent their single family dwellings for. Now, those of you in real estate, you work on the listing side, right? You've probably all dealt with the seller that thinks their house is worth way more than you could sell it for, right? Well, that's that same mentality on these homeowners that think, oh yeah, if I were to rent this, you know, they come up with a number that they believe to be true, or that makes them feel good, and that's what this survey is using. And it's it's causing the drag and the lowering of the shelter costs. It's basically just, it's making it long and drawn out, but we are seeing it move. We are seeing it move lower. And we saw it today with the CPI report, came out at 8:30 this morning. Headline inflation was up 0.4, which was in line with expectations year over year, 3.2 as expected. Really no damage done there. What we're gonna have to see to really move markets in terms of mortgage rates is we're gonna have to see expectations missed on this number. Core CPI was up 0.4. They were expecting 0.3. That's not great, because again, the core number, just like in PCE, that strips out the food and energy. Year over year decrease 0.1 to 3.8, when 3 or up. I'm sorry, I think that's worded incorrectly. We had 3.7 when 3.8 was. So the core, again, the core numbers were not that bad, and I'll edit that and correct that before I send it out to you guys. Core numbers were pretty good. Headline number met expectations, but what's in the report that doesn't get into the news articles and for the media is they're not, let's say, savvy or sophisticated enough to really understand all these components of the shelter costs. But the shelter costs are trending lower, and they account for, and the reason why it doesn't move the core and the headline number is they're accounting for half of the increase that we're seeing in that core reading. They make up about 45% overall, so it's almost half. It's kind of it's again, it's been the thorn in the side of these inflation data reports. PCE, the Fed's favorite measure, is typically a little bit more tame, if you will, compared to CPI. And because we know that the Fed pays attention more closely to PCE, we're more sensitive. If this were a PCE report that came in hotter than expected today, I think we'd see more damage done, because everybody that knows the economics knows that that's what the Fed's zeroed in on. Next Fed meeting will come up before we meet again next month. That's March 19th and 20th. Again, they've been out speaking, publicly. They've now been muzzled. There's a, X number of days before the Fed meeting. They can't speak. They can't, publish articles and things of that nature. So they've zipped it up for the meeting, but the expectation is we will not see a rate move, and the Fed futures for rate decreases is still leading us to believe that we're going to see 3 decreases this year. But if you go back 2 months ago, end of December, going into the first of the year, the markets were betting on 6. And basically the Fed's doing everything in their presentations to kind of stamp out that enthusiasm. Some argue that they're trying to deliberately cool the on-fire stock market. Remains to be seen, but I don't think we will not see any movement, no cutting in March. The next meeting will be April 30th, May 1st. Expectations there for, again, just to hold steady. that it wouldn't be June, it'd be June or July before we see any type of rate cut from the Fed. So all remains to be seen. And a lot of it's going to be, how do these same reports that we look at each month, how are they going to, how do they come in and what's the data going to be like? Because this is what the Fed's looking at. Any questions on that? All right. Local real estate last month in February, I guess due to the timing of our market update, the January numbers were not published for our Northern Virginia region. So we got, NVAR median house price was 650. That's up 6.6% year over year. For all those people that say, "Oh, I'm not going to buy because the housing's going to crash," here's your evidence that it's not going to crash. In Prince William, median price 510, up 10.9% year over year. Dulles area, 669,888, median sold price up 8.3. Yes, sales were down in NVAR and PWAR. Dulles to be up 15.8%. What that means is last January 2023, must have been a horrendous month in the Dulles area, right, to be up 15.8. But that's the year over year, the way they look at it. So, and again, that's good news for that area of real estate, without a doubt. In mortgage lending, a couple of these things we've had on here, they're always worth knowing, keeping fresh in mind. One thing that I did add this month, I don't know about competitors, but we were pleased to be able to add a 15-month term construction loan, just so that you know, most of them are 12 months. If COVID and supply issue things taught us anything, it was to expect delays. And when you have if you're the borrower on a 12-month construction loan, and we're not wrapped up in 12 months and the house isn't finished, well, then that borrower, they can extend, but there's a cost to extending. So the idea that we're tacking on, giving an extra 3 months for those kind of, some of those unforeseeable things, or the things that we can't necessarily control, whether it be, getting materials or things that are in the timeline. I just sat through our Stanley Martin presentation last week, and one of the biggest things that's holding up new construction is really the local governments permitting, things of that nature. These builders are sitting on massive amounts of land, and they are ready and they are fired up to build, but they are getting caught up in some serious red tape before they can break ground and get these lots advertised. So they're at the ready, but there was a big part of that presentation that said they can only do so much, and a lot of it is the slowdowns with stuff at the front end in local governments. Two conventional programs. The one I've added here is a CRA, that's Community Reinvestment Act type of product that some lenders are doing. This one happens to have no PMI, no mortgage insurance. But whenever you got a program like this, you have to remember that it is going to have income limits. This one has very specific geographical limits, and it doesn't follow the Federal Housing Finance Agency's income levels. It actually follows what's called the median family income. So it's a little bit different, a tiny bit more restrictive. Basically $120,080 in annual gross income is the bar for our area. So the borrower on the mortgage would have to be at or below that number. And when you look at the region, it's good in DC. In Maryland, it's only good in Montgomery and Prince George's. And then when you hop across over into Virginia, it's Arlington, Alexandria City, Fairfax City, and Falls Church. The benefits increase when the borrowers fall into, when the property address of the home that they're going after falls within the moderate income census tract. That's typically where you get a little bit boost, slightly, let's say slightly better or lower cost interest rates. But a good program to have, and it's unlike the program there at the bottom left, where that bottom left conventional program. It's great that we as lenders have this ability to do 1% down no PMI. But when you've got X, Y, and Z rules that you have to follow, and one of them for the Northern Virginia region, which makes this product very hard, is that your maximum loan amount can only be $350,000 on that one particular program. It's a grant, and I think what you're going to see is a lot like the state programs, Virginia Housing, Maryland Mortgage Program, DC Open Doors. You're going to see a lot of lenders. They're essentially going to start, using their own capital to do their own grants to kind of compete with that. And these two programs are a really good example of that. Federal Home Loan Bank, upper right hand, leaving that on there. First time home buyer assistance is $12,500. If you're community partners, so that's educators, law enforcement, firefighters, first responders, healthcare workers, and veterans, there's $15,000 assistance there. And the neat thing there is the community partners do not have to be first time home buyers for the $15,000. They do have to have a $1,000 minimum borrower contribution and funds available on first come, first served basis. Household limits do apply. It's part of the program. Essentially, your lender plugs in your borrower profile, looks at their income, puts the income in. The system comes back and says yay or nay to it, whether it's within or it's too high to be able to do the program. And that's, again, separate from Federal Housing Finance Agency, separate from state agency programs. So all of these different programs have all these different, income limits that we as lenders have to kind of keep in mind. And, as we're doing the pre-approvals for borrowers to get them out there looking, we need to make sure that they income-wise if they're going to fit into the box of one of these programs, it's our job to make sure that, they can confidently move forward and knowing that we're within income limits to do some of these programs. I got a funny feeling, I won't be talking much about the Federal Home Bank loan funds because they are dwindling by the day. I think the last report, I think there was our lender access was 290,000. So again, if it's a level playing field, any lender that can offer this, those funds are depleting very quickly. I will tell you, it's one of those things that the Federal Home Loan Bank will sit back, and I think we saw last year, like in July timeframe, they'll cut loose another, lump of money to keep this program going, but it is first come, first served. Questions on any of the lending products? Any general lending questions you might have for me, whether it's related to these or not? No, quiet group. All right, so this month's kind of food for thought. We just did the assisting first-time homebuyers class, and I used these two infographics from a Rocket Mortgage article that was published. And we're talking about in the class, obviously, how the first-time homebuyers are the catalyst to keep this real estate machine churning. And there's a lot of data out there about Gen Z, and in particular, the purple bar graph talks about the percentage of this population that's going to be looking to enter the housing market in the next 1 to 3 and 4 to 6 years that you see there in the center of the graph. And I've been calling that, that's the tsunami of buyers that are in the waiting, right? That are going to be coming to market. We're obviously going to have inventory and housing challenges along with that, but we're going to have a very eager group. A lot of the data tied to these numbers is looking at the age of the average age of a first-time home buyer, and it's typically ages 32 to 34, some you'll see up to 36. That in that age range, that's when that's the most popular time for people to be entering the housing market. And we look at this Gen Z population that's going to be, you know, turning into their low 30s as far as age demographic goes. And unlike their millennial predecessors, this Gen Z definitely has more of a wealth building, family building, establishing roots mentality to it, where the millennial was very transient. They were okay to rent because it gave them the flexibility of not being pinned down into one place. Gen Z, the mindset is a little bit different. As you can see from the other infographic over on the right, a large portion of them, they're looking to grow a family, and they want a place that they can call their own to do that. And they seem to get the financial benefits and the long-term wealth building aspects of owning a home and owning real estate more so than we gave credit to the millennial population ahead of them. So some really good information that, you know, we're going to have this tsunami of buyers that are ready, willing, and able. But I think we're also going to have the challenges of inventory shortage. A lot of the reports and data are talking about into 2030, you know, with inventory struggles. So, you know, I'm starting to see already, I've got clients that if they have to sell a home in order to buy the next one, you know, one client couple in mind, you know, they listed their townhouse, and we're starting to see some of the crazy come back and went for $30,000 over list, all contingencies waived. Yeah, I'm just curious, are you guys seeing some of that? Does it depend on your local market? But I'm seeing some of that. Hey, we got more of that almost 2020, 2021 people with the most money or the highest risk tolerance are kind of winning. And honestly, where does it hurt? Well, it hurts your government loan borrowers. It hurts your veterans trying to do the VA loan, where they can't drop all those contingencies, and they've got to keep appraisal and things like that because it's, you know, it's part of the financing package. Any comments, concerns on that? Anything that you're seeing in the market, please interject. Nobody's seeing the crazy? I'm starting to see it.
Hello, I had a question, please.
Yes.
Do you get information about what is projecting from the builders to build? Because what I understand is the houses in America is shrinking and shrinking. So meaning people want more like townhouses, patio homes, something that is smaller.
Yeah, it's a great question, and it was interesting going back to that Stanley Martin presentation I attended. The president of Stanley Martin was talking about how that is price-based. It's geographic. It's, you know, land. Obviously, and he used the example of all the land they have in Florida, right? Where most of the construction is single-family detached homes. And they're probably like the home that we wish we had more of here, right? You know, one story ranch rambler styles, you know, down there they don't have basements, but up here, if they were to build one, we'd at least have, you know, basement for added square footage. But we don't see quite a bit of that. What we are seeing, at least with Stanley Martin, and they're definitely one of the top builders in our region, is that he flat out said, he's like, yeah, I think he said they're 74% condo and attached townhouses. And when you think about it from the perspective of population trying to meet the demand and then price, more people will qualify for the townhouse condo at the lower prices compared to your $1 million McMansions, larger single family detached, which are still selling well in our region, just not at the clip as to what the smaller attached construction is selling at. And you know, from that price perspective, but then also from the builder's perspective, how do we what's our best bang for our buck? We have limited amount of land in an area like Northern Virginia compared to, let's say, parts of Florida and Georgia and wherever else they're building, right? So they're going to try and build as many units as they can in a more highly populated area like Northern Virginia, because it's obviously better for them. So, you know, I've been, if anybody's like me and been screaming for like, wow, you know, when will the builders start building a modest sized home that's a detached home in this area? And it's never really happened. And I don't think it's gonna happen the closer you get to the bullseye of DC, because they know that the income levels are such that for the people that are higher net worth, they will pay and buy the bigger homes. And they know that they have a greater population of borrowers to buy the townhouses and detached homes. So if you're lamenting that, I feel the same way, but at the end of the day, it's a business for the builders. And they're zeroed in on what sells here. So it's like build more, sell more townhouses and condos, and then try and balance that and sell the larger, higher priced detached single family homes. Does that help or give you some insight?
Yes, thank you so
Yeah,
much.
like I said, it's very geographical. It's very income driven for the area in which the building is going on. Because, you know, we all see that, right? I see that home in Florida that the community our group has in Florida. And I look at that and I'm like, man, I wish they had houses up here like that. Now I'm also thinking, okay, that $350,000 home in Orlando would probably be $550,000, $600,000 if it were built on land up here. But they're not, the problem is they're not building it, right?
Yeah.
It's not in the area. That's a challenge. It's an absolute challenge because for the buyers who are really seeking that detached home, it's like, there's a big gap.
Yes, and also it changes by state, but in Northern Virginia, even the Gen Z want something more sustainable as far as environment.
Yeah, absolutely. But good question, good comment. I appreciate that. Anybody else? Thoughts on local market, Gen Z challenges we face? I got one more last kind of food for thought thing for you before I let you go. I was thinking, I often talk to, when I'm talking to my agent partners, and, always curious as to, what problems are you having? What challenges are you facing? And having that kind of professional dialogue is something that I'm grateful for. And I hear most of the time from agents, the number one complaint is like, I'm like, they say they beat themselves up and they say they're horrible at customer retention. And it got me to think, well, hey, here's something, I want to show you something I do in the mortgage industry that could easily be applicable to you and your real estate clients when it comes to past clients and staying in touch with them, staying in front. And what I do is I do annual mortgage reviews. All right. Now, the purpose of the annual mortgage review is to look at the current loan, see how it stacks up against current financing, and is there any opportunity in the current market where they might benefit from a refinance to swap out the current debt for cheaper debt. Now, obviously, with the last few years, and you can see this if you're looking from left to right, why, if these homeowners have a 3.125% rate, and then I show them what a 70% loan to value cash out refinance is at 7%, and the payment almost doubles. You think, okay, who in their right mind would do that? Why are you showing them that? I'm simply showing them that because if they feel good about where they're at, they should continue to feel good about where they're at, right? And a lot of the questions I get in and amongst when I'm doing these annual mortgage reviews, or, this is more of a home equity report for past clients. And you, again, you can do the same thing in doing a CMA for your past clients. So if for those of you that are doing it, great. Those of you that are not, how much would it take to do? Put the reminder in your calendar with their name, as soon as my people close, I put it in my calendar to annually remind me that their mortgage review report is due. So I always look at the month ahead. I see what clients closed a year ago, and I get this ready. And obviously over time, I'm not just looking at the ones that closed just a year ago. I'm looking at everybody that's on my calendar, because I don't want to just do this once, right? Oh, hey, you bought a home with me. Well, I'll stick with you for a year. I'll give you an annual review, and then you're out of my mind. You're off, you're off my radar and out of my mind. No, that'd be a horrible business practice, right? So the longer and longer I do this, the more and more time I put into creating these reports for the past client. So think of it as, staying in front of them. This person's not going to refinance. I flat out tell them when I go over this with them, right? You'd be foolish. No, no one would do that. But I also get to, in that conversation, is there any need for equity utilization? Do you have any bad consumer debt? Do you want to remodel the bathroom or the kitchen or finish the basement? Because you could not do a cash out refinance and, double your payment, but you might look to add like a home equity line of credit to do some of that debt consolidation or make improvements in the house. So that second and third column, I'm trying to show them, hey, look, here's two ways that, let's say in a hypothetical situation, if you needed 115,000 of your equity, because you're in a great equity position, right? You owe 250,000 on your loan, but the property is estimated at 550 in value right now, right? There's equity there. And then that fourth column from the left is to, get them to think about, or see if they're thinking about, hey, if you thought, is the house still meeting your needs? You ask them that, they'll tell you, right? And that conversation might go down a route where you might now all of a sudden plant a seed in that past client that, now might be a good time to move up, and then you're there to be the resource. Well, how much would I likely walk away with? So in this case, what I did is I said, hey, look, I don't know if it's in the cards for you or if you've given it any thought. And again, merely hypothetical. I'm not pushy. I'm not telling them I think they need to sell and take their proceeds and buy a more expensive house. But what I do show them is on what you're likely to net from the sale, it would be the equivalent of this. And in this particular case, I was showing them, hey, look, you could net X amount of dollars, and that would be equivalent to a 30% down payment on a $750,000 house. Showing them current rate. And then because rates are still, stubbornly high, as we know, I always add in, look, even if you do make that move, I don't want them to think for a second that once they get into that next property in a 30-year loan, that they're going to be necessarily tied to that 30-year loan for an entire 30 years. The reality is we're expecting rates to come down in the next 12 to 24 months. That's been our story. We're sticking to it. It's a matter of time. It's a matter of this data that we talked about earlier. So I just kind of paint a picture like, hey, in a perfect world, that you buy at 6.75 now in a $750,000 house. By the end of 2025, if we're in the mid fours, look at that payment savings there, right? So, and I show them a net worth bar graph to coincide with each of those columns. And you guys can do, similar things with value reports, and there's probably some subscription things that you could do. And I'm not trying to spend your money. We all have to spend our marketing dollars very wisely, especially in markets like this. But if this is something that you think you could do, then I'd say do it, right? Give it a go, stay in front of them, call them. What I do is, mine's all web-based, so I send them a link, a little message. I invite them to schedule a time with me if they'd like to go over it. But when they get it from me, it's got a video of me embedded on the screen explaining these columns to them. And that's what I'm using right now for kind of, touch points. That's what what's at the core of this is, are you staying in front of of your past clients? Your database is your gold mine, right? Don't lose touch with it. Anybody do CMAs and reports and follow up with house data and things of that nature, that value assessments for the past clients' homes? No? Think about it. It's a great way to stay in front of them. Like I said, a year is a long time. And it's not that I'm not touching them some way with marketing or staying in front of them. But when it comes to their mortgage and their value, right, I'm sticking to this year annual review thing. And getting them to think about some of these things, because who knows, we might light the spark by talking about doing a move up buy when they perhaps didn't even think it was possible. Okay. Any questions? Lisa just did some for the past buyers. Love it. Awesome, Lisa. Yeah. Your past clients will appreciate it. They really will, right? They'll appreciate hearing from you. All right. Did I miss any other questions here in the chat? Ashok, first-time home buyer. Are you counting their deferred student debt while qualifying them for the loan for a recent graduate? All right, let me answer that part first. Yes, all the loan programs have a forced calculation. If student loans are on the credit report and it's showing in deferment or forbearance, each loan program dictates how we have to calculate it and plug in a payment based on the outstanding balance. VA is one of those ones where if you're deferred or in forbearance and the date on the report says that the payment's not going to start within the next 12 months, meaning it's further than a year out, you can exclude the debt. Now, in terms of their employment was less than 2 years, that's one, again, that's kind of case by case with loan product. A lot of this, please keep in mind that most of the programs for your college grads, the time in college, getting the degree, and then getting out and starting the job, and maybe not having a long time on the job, but that 2 or 4 years of schooling is considered their 2-year work history. It's part of it. Now, what I will say is it's more favorable because we're gonna ask for college transcripts, right? And what degree did you get? The mortgage industry loves to see people get degrees and then go into a field and go into employment for what that degree was supposed to prepare them for. When there's a misalignment, right? That's when the questions get raised. You might have to have, let's say, 6 months on the new job before we can revisit pre-approval. So it's a little idiosyncratic across program and specific to the program, but yes, that's a good question, and those are definitely something that we have to look at. And again, some are a little more convoluted than others. Believe it or not, conventional loans are probably the most flexible and friendly on that. Whereas the government loan programs, it's documented 2-year work history. And if college is part of that, that's okay. It goes into the 2 years. Ashok, does that help? Awesome. Yes, do you usually send this print email? Yeah, so that's my annual mortgage review is it's a web-based platform. They essentially get a screen that looks very similar to the slide, but it allows them to see these buttons here down here, like more info. When they're on the page, they can click on that and get some interesting tidbits and insights and things like that. So
They want to know what program though. Do you use something that First Heritage provides?
Kind of, yes. It's a lot of lenders will subscribe to the company is called Mortgage Coach. They've rebranded themselves as Trust Engine. It's not necessarily, it's a lending, it's a lender's tool for sure. If I were a real estate agent, I would not pay to have Mortgage Coach. But I'm sure there's something that you could do that creates this. And if your lending partners aren't using Mortgage Coach, you should ask why. Or why not, I should say. Right.
Well, they could co-brand with you and then, let them know that it's coming. That would be the way I would do it.
Right. And again, what I look at this is part of my, right, if I get this client who looks at that fourth column from the right and the light bulb goes on, like, yeah, maybe we should sell and move. This could be a good opportunity for us. Right. I know who the client, who was that client's agent. I get to funnel them right back to the agent to start that conversation if that's something they're interested in. Right. So again, my service to the agents is embedded in this as well. Show VA housing with 2% grants program. Virginia housing, yes. It's a closing cost grant. Yep. Yeah, still exists, hasn't changed. Is that good? Yeah. Yep, still there. And it's great. It's great. Awesome. Any other questions? Well, I hope you leave here with not only the market data, but things to think about as we get ready as an industry to embrace the Gen Z population that's going to be entering the market and helping them with all, right, affordability is not going away. Inventory problems not going away. I think affordability has a greater chance of easing on these to-be buyers than the inventory problem. But we will take what we can get as we get it, right? I've listened to a lot of stuff, a lot of lenders just hunker down, go in a cave and cry the blues that rates are high. And sometimes guilty of those thoughts myself, but really what we can't do that, right? We can't do that in this environment. We have to continue to prospect, we have to continue to serve our database. Because that's our way to maintain, and then we'll get out of this not so great market time. And look, after 2008, we had the longest expansion in the economic growth in housing, and we had a heck of a run. And so there will be more good times on the other side of what we had in the last couple of years.
So Mike, you're going to send the slides out to them. Also, everybody, the replay, once it's rendered through Zoom and then through YouTube, will be on Mike's instructor page at our cindybishopworldwide.com site later today, maybe this evening. It depends on how long it takes. Okay, so we all set?
Good.
Thanks, everybody. And I sent you the who attended so that you could send the slides out to them. Okay?
Awesome. Thank you, guys.
Have a great day, guys. Take care.
Thank you.
Bye.
Yeah, thank you.